Hello, my name is Dan, and in this video I'm going to teach you how to invest in bonds using Trade Republic. Bond investing as a concept is not very well understood, especially when compared to stock market investing. A big part of the reason for why that is, in my opinion, is because stocks are a much sexier financial instrument than bonds. Much of the allure of the stock market comes from that small chance of making it big by choosing the right stocks, no matter how unlikely it may be. A characteristic that isn't commonly associated with bonds. As well as that, over time, stocks have become synonymous with the act of investing itself, mainly because historically, they've always been the most accessible financial product for the average investor. As a result, stocks are much more commonly referred to within investing discourse, and thus are better understood. Plus, we know that the historical investment returns of the stock market over the long term have been superior to that of bonds, further tipping the scales in favor of stocks. However, that doesn't mean that there is no place for bonds in an investment portfolio. There is, and for that reason, they need to be understood. But before we dig into the explanations, let me emphasize that if you're looking to invest in bonds, Trade Republic is one of, if not the best investment platform in Europe for bond investing. Not only is there a selection of 500 highly liquid bonds available for a fee of just €1 per trade, but you can also invest in any of these bonds with as little as €1. That's because Trade Republic is one of the only brokers which facilitates fractional bond investing. This makes bond investing highly accessible for all investors, not just those with the biggest wallets. So I would highly recommend using Trade Republic when investing in bonds, and you can do so using the first link in the description and comment section of this video. Using this link supports me as a creator and lets me know that you found this video to be useful. With that being said, let's get into the discussion about bonds. All sections of this video will be timestamped for your convenience. Let's start off with bond basics. Unlike stocks, bonds are a form of debt, and when you buy them, you become a debt investor. Being a debt investor just means that you're the beneficiary of some type of loan, meaning you are the one who receives the loan repayments plus interest. A bond can be thought of as a type of loan. Bonds are typically used by governments and corporations as a way of raising money. Say the Irish government needs to raise €5 billion to improve Ireland's infrastructure. One way they might go about raising that money is by issuing €5 billion worth of Irish government bonds. That might look something like 5 million bonds issued for €1,000 each. That price of €1,000 is what's known as the face value of the bond. Investors, primarily institutional investors like banks, investment funds, and hedge funds, then purchase these bonds on the primary market directly from the bond issuer. The issuer gets their money and the investor gets what is effectively an IOU. The issuer is agreeing to repay the investor the face value of €1,000 for every bond that he or she owns at some point in the future. That point in the future is known as the maturity date. Maturity dates on bonds can vary from short term, i.e. less than 3 years, to medium term, i.e. from 4 to 10 years, to long term, i.e. more than 10 years. The maturity date of a bond will have an impact on what is perhaps the most important aspect of the bond, the coupon. The coupon is another name for the interest rate that is attached to the bond. For example, if an investor bought a bond with a face value of €1,000 and that bond had a coupon of 4%, the investor would expect to receive €40 worth of interest from that bond each year until maturity, at which point the €1,000 would be repaid. As a rule of thumb, the further out the maturity date of the bond is, the higher the coupon will be. Reason being, investors expect to be compensated for the additional risk of holding long-dated bonds. The reason why there's additional risk is simply down to the fact that more factors can have a negative impact on the issuer's ability to repay the bond over longer time periods relative to shorter time periods. The risk of non-repayment on the part of the bond issuer is known as default risk, and the level of default risk which exists varies depending on the issuer. Fortunately, that's why we have credit ratings. Institutions like Standard & Poor's, Fitch, and Moody's provide letter grade ratings to the bonds that are issued by both governments and corporations. These ratings are assigned in in accordance with the issuer's capacity to meet their financial commitments. The higher the grade, the safer the bond, in theory. For example, Ireland's sovereign debt was recently upgraded by Standard & Poor's to AA from AA-, giving Ireland the second highest investment grade rating that exists. Investment grade just means that there's a low to moderate risk of default, whereas speculative grade signals a higher risk of default or an actual default. As a rule of thumb, the lower the credit rating, the higher the coupon. Again, this is to compensate investors for the additional default risk of investing in low-rated bonds. That's why governments want to have a high credit rating, because it makes it cheaper for them to borrow money via the bond market through a lower coupon, thus lessening the burden on public finances. The other factor which influences the coupon is the prevailing interest rates that are set by monetary policymakers like the European Central Bank, the Bank of England, and the US Federal Reserve. When interest rates are high and rising, new bonds issued by governments and corporations tend to offer higher coupons to similar bonds that were issued in the past. This is because the newer bonds are reflecting the current interest rate environment. There's a very important relationship between prevailing interest rates and bond prices, but before we discuss it, we need to talk about par value. Earlier we mentioned that you could have a bond with a face value of €1,000. When you go to look up the price of that bond, you might find that the quoted price is 100. Not €100, just 100. The quoted price is actually the percentage of face value that the bond is currently trading at. For example, if the bond has a quoted price of 100, that means that its current market price is 100% of face value, which is €1,000. In other words, the current market price equals the initial face value. When this happens, the bond is said to be trading at par or at par value. In reality, par value and face value are the same thing, but you'll commonly hear that a bond is currently trading at, above, or below par. If the quoted price was 90, then the current market price would equal 90% of face value, which is €900, a discount to par. If the quoted price was 110, then the current market price would equal 110% of face value, which is €1,100, a premium to par. Bond prices and interest rates have an inverse relationship. In other words, when one goes up, the other goes down. For example, when the European Central Bank increases interest rates, older bonds that were issued before that increase may become less valuable because their coupons are lower than what is currently on offer after the increase in rates. Therefore, the price of those bonds may trade at a discount to par. Likewise, when the European Central Bank reduces interest rates, older bonds that were issued before that reduction may become more valuable because their coupons are greater than what is currently on offer after the reduction in rates. Therefore, the price of those bonds may trade at a premium to par. In layman's terms, when rates rise, newly issued bonds will pay investors a higher rate of interest than old bonds, so old bonds fall in price. Conversely, when rates fall, newly issued bonds will pay investors a lower rate of interest than old bonds, so old bonds increase in price. How sensitive a bond's price is to changing interest rates is estimated using what's known as duration. The higher a bond's duration, the more its price will fall as interest rates rise, and conversely, the more its price will increase as interest rates fall. As a rule of thumb, bond investors who want to avoid large fluctuations in the value of their bond holdings should stick to bonds with short durations. Those who are comfortable with such fluctuations, or indeed those who are confident that interest rates will fall in the future, should focus on bonds with long durations. Duration is a quantifiable metric for a bond and shouldn't be confused with the bond's maturity date. Interest rates aren't the only factor which can cause a bond's price to change. For example, an upgrade in the credit rating of the bond issuer can result in bonds from that issuer trading at a premium, whereas a downgrade can result in a discount. When the price of a bond changes, so too will its yield. For example, say an investor purchases a bond with a face value of €1,000 and a coupon of 4%. That investor will earn €40 in interest per year from an investment of €1,000. Therefore, the bond yield is equal to the coupon of 4%. However, say the market price of the bond falls to €900. If you were to buy that bond from the original investor, or indeed from any other investor on the secondary market, you would receive €40 in interest per year from an investment of €900. Therefore, the bond yield for you, the purchasing investor, is actually 4.44%, even though the bond coupon coupon is fixed at 4%. Likewise, if you purchase the bond for €1,100, the bond yield would worsen to 3.64%. So, in summary, as bond prices fall, bond yields rise, and as bond prices rise, bond yields fall, again displaying that inverse relationship. Another very important bond metric to understand is yield to maturity, not to be confused with a bond's current yield. Yield to maturity is the expected annual return from a bond's future cash flows, which include the coupon payments made over the life of the bond and the repayment of the bond at maturity. Yield to maturity accounts for both the time value of money and the bond's current price. This metric is a standardized way for investors to compare bonds with one another and is perhaps the most important for bond investing. Lord Abbott provides a great example of how yield to maturity can be used in bond decision making. Here we have 3 bonds with identical maturity profiles. Despite the fact that the price and coupon of the bonds are all different, the yield to maturities are identical. Reason being, while the source of investment returns for each bond differs, the net outcome remains the same. For example, with the first bond, if held to maturity, you'll realize capital appreciation as the bond matures for a higher value than what you paid for it, plus a 1.5% annual coupon. However, with the last bond, despite realizing a technical capital loss as the bond matures for a lower value than what you paid for it, you're receiving a much higher annual coupon of 5%, which balances out the difference. So the question to answer is, do we want the bulk of our bond returns coming from capital or income? The answer to that question will depend on A, your own personal objectives as a bond investor, but perhaps most importantly, B, the differences in taxation treatment between capital and income in your home country. In Ireland, for example, capital gains on government bonds are exempt from capital gains tax, which may provide a case for Irish investors for choosing the first bond over the last. However, many bond investors invest in bonds for recurring income, not capital gains, and so a case could also be made for the last bond over the first. There's also considerations around duration. As we can see, all things being equal, higher coupon bonds are less sensitive to changes in interest rates relative to lower coupon bonds. As such, a further case could be made for the last bond, given that it may exhibit lower price volatility. Regardless, the lesson here is that yield to maturity should be used as your main, but not sole, analytical tool when comparing bonds with one another. One of the ways in which bonds differ to stocks is that losses on bonds can be avoided by simply holding the bond until maturity, provided the issuer doesn't default. For example, if you were to buy a bond at par and that bond subsequently trades at a discount to par, the unrealized loss shouldn't concern you if your plan is to hold the bond until maturity. In fact, because of how bond prices are calculated, i.e. the present value of future bond cash flows, the market price of the bond will naturally return to par value as the bond approaches maturity. This is known as pull to par, and that's why you'll typically see bonds that are close to maturity trading at near 100. So with all of that in mind, we can now look at bond investing on Trade Republic. The bonds that are available on Trade Republic have met the broker's internal requirements for liquidity. One of the challenges that retail investors have historically faced is finding bonds that are liquid, i.e. bonds that can be readily converted back into cash without having to materially sacrifice on price. In other words, there is an ample market for the bonds that are available on Trade Republic, and as I previously mentioned, fractional bond investing is supported. This means that you don't have to have enough cash on hand to purchase one whole unit of a given bond, which could have a par value of €1,000. You can invest in these bonds for as little as €1, though it's typically advisable to invest more, given that the fee for purchasing a fractional bond is €1. You'll notice that bonds can be filtered by duration, varying from as low as 1 to 6 months all the way up to more than 10 years. Bear in mind that more than 10 years is a large category and can go as far as 100 years in the rare case of Austria, who famously issued 100-year bonds back in 2017. Remember, the higher a bond's duration, the more its price will fall as interest rates rise, and the more its price will rise as interest rates fall. So you can set this filter based on what you're looking for. Other filters include type, where you can differentiate between corporate and government bonds, industries, where you can search for corporate bonds in certain industries, country, where you can search for both corporate and government bonds originating from a certain country, and currency, which is pretty much redundant considering the only option is currently euro. Say we're looking at this January 2052 Greek government bond. You can see here that the primary piece of information that Trade Republic displays is the yield to maturity, maturity, which again is the expected annual return from the bond's future cash flows. This is the metric that you should be using to compare bonds on Trade Republic. Trade Republic also breaks down how this return will be realized, giving you an indication of the allocation between capital and income returns. Right now, we can see that this particular bond is trading at a discount to par, given that the percentage is lower than 100. Trade Republic clearly displays the next interest payment date, duration, as well as other relevant trading information such as the bid and ask, ISIN, and the bond issuer. We can also see the original product information, including bond type, maturity date, coupon, payment frequency, currency, and the issuance volume, i.e. how much the bond issuer issued in total. Clicking on buy, you can see that you have the option to either buy any euro amount at the current market price or buy and specify the amount that you'll receive back. If we were to invest €1 using the amount option, we would receive the equivalent amount of fractional units that €1 can buy at the current market price. But if the current market price is above or under par, as it likely will be for most bonds, how much we invest won't equal the amount that we receive back at the date of maturity. However, if we were to invest €1 using the face value option, we would purchase what is effectively the current bond quotation, which in turn will give us back the specified amount at maturity. So, for example, if we wanted to receive €1 back from this particular bond at maturity, our total investment will be equal to 57 cents, i.e. 57% of par value being the current quotation, plus any accrued interest, plus the Trade Republic fee of €1, giving a total investment cost of €1.59. My personal preference is to invest using the amount option, but you're entirely free to choose whatever option best suits you. It's important to clarify that when you purchase a bond on Trade Republic, you're actually trading on the secondary bond market. In other words, you're effectively purchasing the rights to receive the bond coupon plus repayment at maturity from another investor who previously held those rights. You're not directly lending to the bond issuer. That is done on the primary bond market. This is the exact same as how you trade on the secondary market for stocks when accessing stock exchanges via online brokerage platforms. Also, before you invest in any bond on Trade Republic, make sure that you check the credit rating of the bond issuer. This is a relevant factor to consider, and it's very important that the bonds you're investing in align with your attitude towards and tolerance for risk. Simply type in the bond issuer's name followed by credit rating on Google and you should get your results. With that being said, if you do want to start investing in bonds using Trade Republic, you can do so using the first link in the description and comment section of this video. If you have any questions on any of the material that was covered in this video, please don't hesitate to leave a comment down below. Thanks very much for watching, and I'll see you soon.